Alright, so this week we're going to talk about order types, stops, and targets. And my primary focus is going to be order types. You might be thinking to yourself, order types, that's way too simple. But there are a lot of different order types out there, and it's something that's very important to know that you have all these variety of options. So the most simple and most familiar order type is going to be your market order. Your market order just simply means that when you're buying or shorting a stock, let's say we're entering a trade, you might place a market order, which means it's going to fill at the market price. You're not establishing any specific price that it's filling at. It's just going to fill at whatever the market price is at the time that you hit buy. So you're going to guarantee a fill, but it's not always going to be guaranteed as the best possible fill. To avoid getting awful fills and being manipulated by market makers, it's key to always use limit orders. I use limit orders pretty much 99% of the time. There's cases where if I really want to get out of a trade and I don't really care what it is and maybe it's somewhat of an illiquid stock, I'll use a market order and just take a little bit of a hit on the overall fill, but I guarantee that I'm going to fill the trade. But 99% of the time I'm entering and I'm exiting with limits. This basically means that you're establishing a specific price point at which you want to buy the stock. So let's say, for example, we've got a stock that's trading at $210.50, and you want to get in at 210.45, nothing more. So you put the buy order in at 210.45. It would require the stock to pull back 5 cents before you would get a fill from that 210.50 to 210.45. Now, if you used a market order in that situation, then it's going to fill right away at either 210.50 or higher. But if you use a limit order, it's going to require it to pull back. You're going to get a little better fill. You may miss out on the trade because you're requiring a pullback, but you're going to get a better fill, and you're going to guarantee a specific price point or better on the fill. Now, with regard to stops, there's two different types of stops. We have a stop and we have a stop limit. A stop basically is when you are in a specific position. Let's say we're in a long position at a stock that we purchased at $100. It's currently trading at $110. We want to put a stop in at 100 to guarantee that we break even or on the trade now that it's ran 10 points to the upside. So if you put a stop at 100, that means that if the stock pulls back to the 100 price point, it's going to trigger a sell order, and it's going to execute it based on market order. So a stop's going to execute based on a market order per the stop price that you've established, and then we have a stop limit. So in that exact same scenario, we've entered a stock at $100, it's ran up to $110, we're placing a stop limit at that $100 price point to guarantee break even. And if the stock pulls back to that 100 price point, let's say it flies through it, alright? It flies down to like 99. Well, with the stop, you're still going to fill at that 100. It's going to trigger the sell order at 100, but since it flew through it, maybe it'll actually execute at the market order price of, say, $99.80. But the stop limit, it's going to trigger the sell order at 100, but unless it can fill at exactly 100, your stop limit price, or better, it's not going to fill. So it'll trigger the sell order, but it's going to require it to come back up to 100 or better before it's going to trigger. So there's pros and cons to the stop limit. I tend to use stops. Sometimes I use stop limits. Just because if I want to get out of a trade, I want to get out of it. If I want it to stop, I want it to stop. And the stop limit can prevent you from actually filling on that trade, which can add a little bit of an element of risk to that situation. So just keep that in mind. We have the trailing stop. The trailing stop is when, let's use that example again, we've got the stock at 100, it's rolled up to 110. Instead of placing a stop all the way back at 100 to guarantee break even, maybe we want to lock in some profits, but we still want to give it a little breathing room. You could put a five-point trailing stop on it. So basically what it's going to do, if the stock's at 110 and you put a 5-point trailing stop, it's going to establish that first stop at 105, all right? And it's going to stick right there at 105. If the stock pulls back to 105 from that 110 point, then it's going to put a sell order in at 105 market. If it continues to run, let's say to 115, it's going to edge it up 5 points. So your new stop is going to be at 110. Okay, so it's gone up. As it goes up, it inches up with the upside momentum in the stock. So it trails that stock by whatever your established trailing spread is. So if it gets, say if it just goes from 110 to 111, it's going to push it's a 5-point trailing stop, so it's going to push from that 105 initial to 106 because it just went up 1 point. One thing you got to remember though is once it goes up, it never goes back down. It doesn't trail it on the way down. It only trails it on the way up, and vice versa if you have a trailing stop on a short. Trailing stop limit, same situation, except if it pulls back to your trailing stop point, it's going to be a stop limit instead of a stop market order. So, if it flies through that trailing stop limit point, it's going to activate the sell order in the event you're long, but it's not necessarily going to fill until it gets back to that exact stop limit point. These last two, we've got market on close. That's MOC, market on close, which means it's going to automate a market order at the closing bell. So if you want to get into a stock at its closing price, you don't care what the specific price is. You just want to buy or short a stock at the close, as close to the closing bell as possible, and you want to automate that situation. You're going to use a market on close. There's trades called gappers, overnight gappers, where you might anticipate a specific momentum carry up overnight, or maybe you want to buy something at close prior to earnings. Well, you can place a market on close order, and it's going to fill it right, maybe like 30 seconds prior to close, 30 to 10 seconds prior to close at the market price. Then there's limit on close, LOC. Same type of situation as market on close, except you have to establish a limit order at which you are willing to pay no more than that specific price. So as long as it's at or better than that specific limit order price, it's going to fill for you at the close. But if it's worse than that limit price that you've established, it's not going to fill at the close. So there's our 8 different order types. And if we go over here, we're going to take a look at some different options that you have as far as when you actually place the orders. You can either do a single order, and your single order, you're going to establish what type of order it is. But a single is just basically you're buying a stock, you're shorting a stock, you're buying a call, you're buying a put, just a single order where it's just one single thing. You're buying a vertical, you're buying a butterfly, just one single thing. You don't need any other action on top of that. You've got OCO, one cancels other. So basically, if you're already in a position, say you're day trading Apple, for example, and Apple's sitting at 260. You can place a one cancels other order to establish your stop and target. So say you want your stop at 259 and you want your target at 265. You can have an OCO order with a stop at 259 and your OCO sell at limit 265. And if the stop triggers first, then it's going to cancel that target exit order. If your target triggers first, it's going to cancel your stop order. So that's how you establish stops and target and automate that whole process. You've got blast all. So if you have a number of trades that you just want to just blast them all out, maybe like some sort of basket trade, then that's when you're going to use the blast all option. You've got first trigger sequence. So it's going to require the first trade in your your sequence of trades to trigger. It's going to have, so let's say you have Apple. We'll use Apple again, and you want to buy Apple at 260, and then you want, only if that fills, you want to put a vertical put spread, buy a vertical put spread for protection on that position. So say you want to buy the 250, 240 vertical put spread, which is a bearish vertical that will give you a little bit of protection for a little bit less cost than the actual buying the put outright. So the first thing that's going to happen is Apple's going to need to fill at that 260 limit price before it's going to trigger the sequence for the vertical to basically spread, or for the vertical to fill rather. And then we got first triggers, one cancels other. So if you want to get real fancy when you're day trading and you think your time is not as much of the essence as it typically should be with day trading, you can put your order in for the trade and couple it with the OCO, with the stop and target, so that instead of just entering the single order for the day trade and then placing your OCO as a separate order, which is your stop and your target, you can couple placing that single order with the OCO. So basically it's going to say, as soon as your day trade fills, it's going to trigger the stop and target order. So you're just going to have everything automated. It's boom, right there as soon as you hit order. As soon as that fills, it starts working the OCO order. It's pretty cool, but The only problem with that, with day trading, is that time is typically of the essence. So I always enter the single first and then place the OCO order. I have used first trigger OCO on some swing trades in the past. So it's primarily personally used for swing trading and longer term trading, not day trading. But I was just using day trading as an example there. So these are the different variations of order types. I want to get a little bit more in depth on stop and target, as well as kind of show you how to access all these different order types on the Thinkorswim trading platform that I use. So let's take it over to the computer and we'll finish up. Okay, so let's say we are working on, we want to buy UPS. All right. So UPS, if you look down here towards the bottom where my cursor is, we're saying buy 100 shares of UPS, 63.77 is the current price. And if you look here where it says order, there's a drop down box. And you've got the option of each of the orders we went over: market, limit, stop, stop limit, trailing stop limit, and then your MOC and LOC orders. So that's where you choose which of the order types you prefer. I like Thinkorswim here. We're looking at the Thinkorswim trading desktop trading software. They default to limit order. You can change your default, I believe, to whatever you want. Whether I don't see why you'd want anything other than limit as your default though. But I believe you can change it. And here you have the choice between day, which just means that you're going to work that order today, and then it's going to cancel itself after the trading session, or you can do GTC, which is good till canceled. These different exchanges, it defaults to best. Sometimes you can change it, sometimes you can't. Just depends on whether you're trading options or specific types of index related ETFs or things along those lines. And then down here on the bottom left where it says advanced order, right, it defaults to single order. This is where the options that we went over can be found. The second set of options that we went over. So you got single order, blast all, first trigger sequence, first triggers all, first triggers OCO, first triggers 2 OCOs, first triggers 3 OCOs. It's pretty intuitive what the difference between first triggers OCO and the other two are. And then you've got just your straight up OCO. So that brings us to stops and targets. If you take a look, we'll go into a short-term chart here. And I know Amazon has got some decent action going today. So let's say that we got long Amazon this morning, and we're long based on this intraday uptrend. All right, so reported earnings yesterday, had a huge gap to the downside. It's been filling this gap throughout the session. It's almost completely filled it. You want to see if you can get a complete gap fill. You're long the stock, and you want to see if you can get a complete gap fill. So what you could do, let's say that we entered right here on this break to the upside. So we entered right around 110.50, all right? So after we entered, the first thing you want to do is establish your stop prior to entry and compare the percentage loss on the stop if the stop were to hit to where you anticipate the gain, which in this case our target here is a gap fill with a target of 120. And if we put a stop here, we'd want to have the stop just under this 110 price point. I'm sorry, 109 price point. We got some nice intraday support, and that's kind of the start of this uptrend. So, maybe 108.70. So once you fill your order on the buy side of Amazon, you'd want to place an OCO order with a stop at 108.70, and then you'd also say a sell at limit of 120. You might want to go just under 120, just because 120 is kind of a big psychological barrier. So just under it, maybe like 119.70. So you do the OCO, stop 108.70, target 119.70, and let's say that it continues to run to the upside. All right. So now we're right at this point where we're well into positive territory, and we're in at 110.50, and right now it's trading at 114 at this level we just circled. At this point you can revise your stop. So you'd want to keep the stop. You give it a little breathing room under this uptrend support line. And so maybe just a little under 112, because 112 is a nice psychological barrier as well. So you're forcing it to break through uptrend support plus this 112 psychological barrier. So here we put maybe the stop at 111.70, and that would give us some breathing room, letting it continue to run to the upside, but it also locks in some gains. So you keep your target there at 119.70. So you just make a revision to the stop of
from 108.70 to 111.70. And as it continues to run to the upside, now we're seeing a little bit of pullback. It actually looks like it might be done for the day, done running up. Not sure if it's going to fill. So at this point, you might want to you give it a little breathing room under the uptrend support. So looking good, pretty much right around 113.70. So then just revise your stop from 111.70 to 113.70, and let it continue to give it breathing room as it runs. May or may not fill this complete gap. At this point, you have a nice strong profit locked in from 110.50 to 113.70. That's a great day trade. And if the stop hits, so be it. And if that stop does hit, it will cancel the target, the sell at 119.70 limit, and you'll be good to go. So that's kind of the basics of the stops and targets as far as being applied to day trading and how you can utilize the OCO orders. But I primarily wanted to focus on these different order types and how to establish and differentiate between them, and how to choose them, most importantly, in the Thinkorswim trading software. It's going to be pretty similar in your trading software if you're not using Thinkorswim. And if you can't figure it out, I would suggest just calling your broker and saying, "Hey, how can I change my order types, and how can I choose some advanced orders like OCOs and first trigger sequence?" So if you're interested in doing these types of orders but can't figure out how to do it in your specific broker, and you don't use Thinkorswim, then I would definitely suggest just giving them a call on their help desk, and I'm sure they can help you out with that very quickly. We'll see you next week. Take care.